How are you losing $1 billion and going to sleep at night? I'll be up like this. Both companies dead broke and unprofitable. These business models suck. Just nothing but losses. They've been taking L's every single year. Kind of like your ex. These companies have literally never earned a profit. Not even 1 penny of profit. And the crazy part about it is these are all household names. You and I know these companies. You and I always use these companies. So let me expose some companies that might have high revenue but cannot make a dollar to save their life. So maybe after you see this, you'll be a little more gentle on some of these companies, all right? Keep it locked for all that and more. It's Crystal with the Cash Compass. All right, welcome back. I am here to teach you all the things that you should have learned in school about money, but for whatever reason, they forgot to mention it. If you love all things personal finance, investing, and economics, you're definitely going to want to subscribe. And while you're down there, make sure you hit the bell. Let's get into it. Now, before I get into the list, I want to talk about how this is even possible, right? Because maybe back, I don't know, maybe 30, 40 years ago, this would have been unheard of. But these days, there's a weird phenomenon going on that's allowing these companies to basically stay alive, even though they should have been long gone and dead. So what has been looking like a very profitable business model is private equity and these venture capitalist companies target big companies that are maybe not yet public. So they're private companies, but they have a lot of buzz around them, okay? You could think about like Chewy, for example, a couple of other companies that may have been private before they actually IPO'd, Airbnb, and a few of these other companies. So basically what these private equity and these venture capitalists do is they come into these companies, they throw a whole bunch of money into them to help them with marketing, maybe research and development, really to build the company up and make it a household name. Once it becomes a household name, they cash out and peace out in an IPO. Now, this is extremely profitable for these venture capitalists and these private equity funds because they're basically saddling these companies up in debt, okay? So these companies probably weren't making a profit before, but these venture capitalists and these private equity firms are subsidizing their losses. So you're like, don't worry, you're losing $100 million a year? We got that. We'll pay it off for you. No worries, right? So they'll subsidize these debts. They'll go ahead and help this company rise to the top. And then in an IPO, they've already gotten some shares. They'll dump all those shares and then they just exit the company, okay? It's a great exit strategy. You make a lot of money. And basically all the money that they've probably lost just kind of throwing into this company, they've gotten back. A lot of times it ends up leaving them zombie-like, right? And when I say a zombie company, I mean they're not making any money. They're making a lot of revenue, but they're not making a lot of profit. Their expenses exceed their revenues, right? So they're just zombies. They're not making a dime, and they're just burning through cash with the help of these private equity funds. And once these companies go public, they're burning through cash with the help of you, okay? So if you're invested in any of these companies, I'm not telling you to sell your portfolio. You know, in the short run, it might be actually really profitable, but keep a watchful eye. All right, so number 1 and 2 on the list is Uber and Lyft. Both companies dead broke and unprofitable. These business models suck, okay? They don't work. So if you've ever gotten mad at Uber or Lyft for these prices rising, especially during COVID, because let's be honest, everything has been going up due to COVID, they actually need this, right? They actually need to come up with some more money and charge more because what they're doing right now is not profitable. And I'll take you on my computer so you can kind of see what I'm talking about. So this is Uber and this is their balance sheet, okay? So when it comes to solvency, and let me explain what that is. When you're solvent, that basically means your assets exceed your liabilities. In most of the companies that I'm going to go through, they actually are solvent, which is great, right? So they have more assets than they do liabilities, but they're still not making money. And here for Uber, their total assets are actually 31 million. I actually call it 32 million, right? Close 32 million. Liabilities are only 16, call it 17 million. So they're able to satisfy all of their debt if they had to. They'd have to just, sell some of their assets or collect on some of their assets. They have a bit of accounts receivable here. But they could definitely pay. They have a lot of money in cash. That's one thing about it. They got $10 million sitting in cash. So they have the cash, but can't afford it. And they actually made it out the mud a little bit, right? We can see they actually had a little bit of income this year, or 2018, excuse me. But it's just been kind of sitting in the losses lately. 2020 makes a lot of sense. People weren't going anywhere, all right? But what's 2019's excuse? They made $13 million in revenue, so $13 million in fees, whatever you guys paid for Uber, that's what they made in their fees. The cost of revenue wasn't too bad, right? So the actual business of collecting, whatever the fare is and then having to pay out their people is profitable, but then they have all this other stuff, operations and support, sales and marketing, research and development, and all of these things, and depreciation, which is not a real expense, but it's a great expense for tax purposes. But either way, all of those things greatly exceed their revenues. So they are making nada, actually lost $8 million in 2019 and slightly improved, losing $7 million, okay? I would cry if I lost $10, okay? When I lose money in my wallet, like a little $5 bill, I'm in heat. So I don't know how they're doing this and just keeping on, okay? I would have been out of this company a long time ago if I was working here. Another good thing to look at when you are looking at financial statements are the cash flows. So the cash flows is nice because it shows you what is actually going through in the cash. It backs out and adjusts for all those non-cash items, and you can really see what the business is doing. The cash flows are divided into a couple of different sections. You have the truly operating, you have investing, and then you have financing. We're going to focus on operating because I do not want to put anybody to sleep going through all this other stuff. But if you're looking at their operating cash, you'll see how much money actually came from their operations. And as we can see here, every single year, they've actually had net cash used in operating activities versus net cash provided by operating activities. You want this to say net cash provided by operating activities. Operating activities are your bread and butter. It's what you're doing day to day. It's the day-to-day operations. And if you are losing money in your day-to-day operations, that's not good. Okay? So they've been losing. They lost 1.5 in 2018, 4.3 in 2019, and $2.7 million in 2020. So overall, even though they might have had a little bit of net income in 2018, you can see here their loss from their actual operations. It's just nothing but losses. They've been taking L's every single year. Kind of like your ex. Lyft is not that much different. They've actually had net losses, period. They haven't even had any type of income at all. As you can see, their income is considerably less than Lyft by a lot, right? Or by Uber, by a lot, because Uber had bought in, I think it was like 13 million or around the teens. Over here, they're pulling in something. They pulling in a couple billion, but nothing too crazy compared to Uber. And then another thing that's kind of interesting to talk about here is that the financing activities, net cash provided by financing activities, this is basically all the debt that you go into. So unless you're paying off more than you've actually borrowed, this number should be positive, right? And they've been positive every single year that we've been looking at. So they have just been kind of taking in more debt and not actually having a net payout, okay? So they're kind of stocking up on the debt. And let's see, that should be visible here too, because the long-term debt should increase. Yep, you see, long-term debt over here was 0. Long-term debt here is $644 million. So we know in 2020, they took out a good amount of debt, okay? Y'all have been on Airbnb's neck lately, okay, with the chokehold. They have not been getting a break. When I was preparing for this video, I originally was just going to talk about their fees because a lot of people have been complaining about the crazy fees that they have been receiving through cleaning fees, which I don't necessarily think is Airbnb's fault. I think it's the individual, leasing people who are listing their property. But anyway, now y'all are mad because apparently they still have properties listed that are in Palestine or something like this, right? I haven't looked into that too much. But staying on topic, Airbnb as well has not made any money. So if they are responsible for these fees, I mean, guys, if you guys want Airbnb around, they have to charge a little bit more money because their business model is not a viable one. They are not making money as it currently stands. So they are a little thirsty for the fees. Their losses have been dramatically increasing, okay? 2018, we had $16.8 million of losses. Then it dramatically jumped up the next year to $674 million. And it's even worse this year at $4.5 billion. How are you losing $1 billion and going to sleep at night? I'll be up like this. Anyways, it seems like a lot has come from, product development. So they are trying to, better develop their product. I know that I've noticed that they've also been introducing things as experiences. So it's not just places to stay, but they're telling you things to do, which is helpful. But baby, they was really investing in that. So that drove a majority of the costs. For the most part, they have been profitable as far as their net cash coming in from the operating activities. What's interesting to note is, their stock-based compensation expense. At first was 53 million, then 97 million, then it jumps to 3 billion. Y'all are not making money. Why are people getting given so many stocks? And obviously they also went public, so that's a piece of it too, of course. Like, now that you're public, you should get a lot of money. If you guys have ever gone through, if you're an accountant, my accountants out there, or people who have gone through going public, it is not fun. So people definitely do deserve some stock compensation for that. And this is just a dramatic amount. Moving on. Chewy, all my animal lovers out there, you definitely have heard of this company. They revolutionized the way people order food and supplies for their pets, okay? But they're broke. This is actually the first company on the list that is not only not making any money, they're also insolvent by definition, okay? Like I said earlier, insolvency means you have less assets than you do liabilities. If all your liabilities became due today, you could sell everything, including the shirt on your back and the plug outlet, and you still would not have enough money to pay off your debtors, okay? And that's the situation that Chewy is in. As you can see, they have $932 million of assets, but 1.3 billion with a B of liabilities. So they'd be in deep doo-doo if they had to pay all this back right now. And even if you look at their current assets and current liabilities, current asset liabilities, is 1.1 billion versus current assets of 629 million. That's normally never a good place to be in because all those current liabilities are due within a year, okay? So the assets that they have coming within a year would not be able to cover the liabilities that they have coming within a year. So they need to kind of keep a watch out on that. Let's see the money, the shmoney, okay? Like I said, they've been losing to the tune of about $250 million every single year. It's getting better though, as you can see. 2017, 338, 267 here, and $252 million of net loss here too. So they are improving. When you have a company growing so rapidly, I guess it's hard. And they were also shooting out new things seemingly every single month. So, they're in the right direction at least. Other companies we've been looking at, they've kind of been all over the place, but this seems to be going in an uptrend. All right, it's getting a little bit long, so I want to end it there. But Peloton and Pinterest both also have suffered losses. Pinterest, a lot of their losses was driven by research and development, but it's like, what are you researching, huh? We're the ones who do all the work and post the things on Pinterest. What is there to spend billions of dollars on? I don't know. And Peloton, as expensive as those bikes are, it's really odd that they're not making any money either. If you want to look at their financials yourself and kind of test out what we've talked about, I'll drop the link to the SEC in the description so you can click it and play around with any other companies you want. So did any of these companies surprise you? Let me know in the comments. I definitely want to hear from you. But that will do it. If you like this video, then please be sure to like this video and share it with your friends. And if you have anything else going on, you know what to do. Go ahead and binge watch me. And until next time, keep your money up.